All right, so the last part of Chapter 7 we're going to cover is return on assets. Return on assets, which is a fantastic ratio. If you only had one ratio, this is the one you'd want to have. So it's taking net income over average total assets. So if you think about the company and our accounting that you're learning, you have assets and liabilities and stockholders' equity. All right, and these assets are resources to make stuff. So all these assets, this is all the firm has to produce goods and services for the company. And this is how the liabilities of stockholders' equity are how they got the resources. So how they got the resources might be interesting, but if all the resources you have and you're still not creating a lot of value for your customers, it's really not going to be a very useful company. All right, so this ratio is net income, which is after all is said and done with our operations, does it look like we produced more than we used up? And as a function of the total assets we had in the denominator, average total assets. So this one ratio is telling you how effective the enterprise is at producing value for its customers. Okay, so sometimes the asset side of the balance sheet is referred to as the Main Street side, and the liabilities and stockholders' equity is the Wall Street side, the finance side. Is the right-hand side of the balance sheet is telling you a story about how they finance, how the corporation finance all the stuff, and that's important. But if it's a company that's not producing much value, we're not really that concerned about how it's financed. Okay. All right. So net income over average total assets. One nice technique that's been developed for, boy, a long time, maybe 80, 100 years. Been around a long time, is DuPont analysis. And this is kind of nifty because you can decompose ROA into two different component ratios, and it tells a story. So the two ratios are net profit margin and asset turnover. Net profit margin is telling a story of net income as a component of, as a percent of sales. So basically, well, net sales obviously is your revenue, but net income is how much you have left over after you take out all the expenses. So it's telling a story about how you're managing your expenses, and also the market power you have, your ability to charge above cost of goods sold if you're a merchandising company, or above the cost of providing a service if you're a service company. Then the asset turnover ratio is for your sales, how much sales you're generating per dollar asset. So this is, are you managing your long-term assets well? Okay, and you put those two together, you know, mathematically net sales and net sales cancel out. But if you look at each ratio separately, it gives you a way to analyze the performance of the company and say, hey, what can we do to improve ROA? All right. So again, net profit margin is going to measure your market power. You know, you have if you're a merchandising company, you have a cost of goods sold. But like with Apple iPads, they can charge a premium. Are you one of those companies? But also, you know, if you're an industry with a 10% ROA and yours is lagging, is there some problem with your operational efficiency? That's where you would get into the expenses and net income. Net sales to average total sales just measures the ability to generate sales per dollar asset. So how effectively you measure you manage your long-term asset. So if your total asset turnover ratio is a problem, then what you have to do is start looking at what assets am I going to get rid of. Okay, we're going to look at this Garza Incorporated and do just a brief example. bunch of numbers on this slide, but we're going to deal with the 2003 here and here. So you can flip back and forth, obviously, but we're going to deal with the 67 and the 2000. And for the total asset turnover, we're going to have to go back a year. But we'll flip up and we do some interpreting. So the net profit, it asks to calculate net profit margin, total asset turnover, and ROA. Okay. The net profit margin is 2.99%. That's 2,000 over 67,000. Really not too much to get excited about. Now for banks, if this were a bank, it would be awesome, totally incredible. You would be on the cover of Forbes if you're running a bank with a 3% return on a net profit margin. Okay. Total asset turnover 1.57 times. All right, but generally that's kind of low as well. ROA is 4.71. This is kind of low. You know, a little bit lower than that, you're like in grocery store territory. So this number very much depends on industry. You know, banks are like 1% to 1.5%. They don't call it ROA, but it's somewhere in there. So ROA is low. So right away, you don't know the industry here. We don't have it. It's not a full-blown case. Is it a competitive industry? Or do they do a poor job of managing expenses? Okay, so let's look at net profit margin. Here you have 67. So they could make that number larger, but you know, oftentimes it's driven by the market demand. But you could. If we look down the expenses, really there's two giants here. Cost of revenue and SG&A, right? So we have other revenue, we have income tax expense. You're not going to touch income tax expense. Other revenue is 1,000. The odds of getting it down to 0 are probably pretty low when you have an expense that low. All right, so here are 46 and 16 are the two big targets. The most obvious place I would think is SG&A. That's referred to as overhead expense, selling, general, and administrative, back office support. Each $1,000 cut will increase net profit margin over 1% and ROA over 2.5 percentage points. So even if you don't cut it 1,000, if you cut it 500, that'd be a huge improvement. Of course, the cost of service, you'd also look at that, and you might have some improvement there. The problem with the cost of service is, are you going to adversely impact either the quantity of sales or your market power, meaning how much above the cost of service you can charge? All right, so you'd have to, not that you couldn't, go look at the cost of service. You just would have to be a little more confident and a little more rigorous in terms of your implementation plan. Okay, increasing asset turnover. So let's go see what they have over here. We have total current assets and property, plant, and equipment. Other assets, forget about it. So now total current assets, we don't have current liabilities, so we can't really see how we're managing or mismanaging our liquidity. If we could find a better way to manage our liquidity, like using lines of credit and that type of thing, we might increase our asset turnover, which would increase ROA. So it really depends on liquidity needs. We don't have that information here. We could also review the utilization of long-term assets and eliminate underutilized long-term assets or find a way to redeploy them. So by doing that, you could decrease your total assets and you would increase turnover and ROA. So right here, these two expense lines, and right here, these two asset lines are where you would start your investigation. All right, and that's how ROA and DuPont analysis works. Very simple, yet very powerful tool. You know, for larger companies, this type of thing is well known, and analysis is much more sophisticated. But I got to tell you, for smaller companies, even of a good size, like 100 employees, this type of analysis can be very, very useful. And this is the end of Chapter 7.